And welcome back. As expected, the Federal Reserve increased the federal funds rate by 75 basis points yesterday. This is actually the fourth consecutive increase of 75 basis points by the Fed so far this year. So I'm going to be sharing how this is impacting current consumers right now, but also our housing market as well. And with that said, let's go ahead and dive right in because I have a lot to share and hope you guys appreciate these timely housing market updates here. So let's go ahead and dive right in. So again, the Fed increased the federal funds rate by 75 basis points yesterday or today at the time of this video, which is the 2nd of November. So they approved a fourth consecutive 0.75 point interest rate increase. Markets were expecting this. I'm going to be sharing some data regarding what the Treasury yield is doing today and also mortgage rates as well. But the increase of federal funds rate by 75 basis points. And now the new target range for the rates right now by the Fed is 3.75% to 4%, the highest levels since January of 2008. And the Fed issued a new statement and they actually hinted at a new policy change or a potential policy change in the months ahead. There's a lot of talk about a step down policy. And so we could see only a 0.5 point increase of rates in their next meeting, which is in December. Again, they increased the federal funds rate by 75 basis points for 4 consecutive weeks now. But the street is forecasting that the Fed's going to increase rates by only a 0.5 point in their next meeting, which is December. Also, they're calling for potentially fewer, smaller hikes in 2023. So let's look at investing.com. They have what's called their Fed rate monitor tool. If you just Google that, it takes you to this website right here. Their next meeting by the Fed is actually on December 14th, their last meeting this year. So they're calling for a 61.5% probability that they're going to increase rates by 50 basis points. And then a 38.5% probability that the Fed's going to increase the federal funds rate by 75 basis points. The significance regarding this is that this is much different compared to yesterday's forecast because yesterday the street was more or less split between a 50 basis point increase versus a 75 basis point increase. But after the Fed's announcement today, that increased to 61.5% probability for a 50 basis point rate hike in December. Now, briefly, I want to talk about how this rise in rates are impacting consumers overall. And I'm going to be talking about how increasing mortgage rates are impacting home buyers as well right now. So it says here, this is on CNBC's website right here, that even though 15-year and 30-year fixed rate mortgages are tied more directly to Treasury yields, I have some news regarding that here in just a little bit. And of course, the economy, anyone shopping for a home has lost considerable purchasing power, in part because of inflation and the Fed's policy moves. So in regards to purchasing power, the general rule of thumb is that for every 1% increase in mortgage rates, that causes a 10% decrease in buyers' purchasing power. And because rates have increased about 4 percentage points over the last 12 months, that causes approximately a 40% decrease in buyers' purchasing power. And this, in my opinion, is one of the main reasons why our housing market is slowing down. And of course, a lot of people are getting priced out of this housing market or simply giving up, given the fact that rates have increased so much. Other impacts regarding the Fed increasing the federal funds rates is credit card interest rates, because there's a direct connection to the Fed's benchmark that it says right here in this article. It says here the average rates for credit cards is very close to 19% right now, up from 16.34% in March. And have a look at this because this is pretty insane. This 19% rate, this is the highest rate since the Fed began tracking this data back in 1994. It's also more than a full percentage point higher than the previous all-time record high that was set back in 2019. So not only are interest rates increasing for credit cards, they're also increasing for brand new auto loans as well. So auto loans tend to be fixed, but in order to get a new auto loan, have a look at this. The average interest rate on a 5-year new car loan is currently 5.63%, up from 3.86% at the beginning of this year. It also says this could increase over 6% after the Fed increased rates today. Now, there is one silver lining regarding the Fed's rate hikes. This is because the interest rates that banks pay on savings accounts tends to increase. Now, changing gears slightly, I want to talk about mortgage rates right now because the 10-year is at 4.096%, an increase by about 4 basis points today. Again, this is the 10-year U.S. Treasury note, which is tied directly to fluctuations in rates. So when the yield increases, so can rates. So rates increase slightly today. According to Investopedia.com, as of today, which is the 2nd November, average rates nationwide with people with exceptional credit, always have to say that disclaimer, is 7.18%. Also, according to the Mortgage News Daily, rates increased by 3 basis points today to 7.12%. A 15-year mortgage at 6.54%, FHA and VA around 6.7%. And also 1 year ago, rates were at 3.14%. In other words, rates have increased nearly 4 percentage points from 12 months ago. Hard to believe with rates at 7% right now that we had rates at 3.14% 12 months ago. Absolutely insane. And of course, because rates have been increasing so much, we've been seeing a decrease in the number of applications for mortgages. So this is just announced today at the time of this video, which again is the 2nd. This is according to the Mortgage Bankers Association, or the MBA. So total applications for mortgages decreased by 0.5% from 1 week ago for the week ending October 28th of this year. And this again includes refis plus purchases. So have a look at this. The refi index increased by 0.2% from last week and was down by 85% from the same week 1 year ago. So refis are more or less falling off a cliff given the fact that rates have increased so much. And in fact, by my analysis right here, this 85% decrease on a year-over-year basis is the biggest decrease we've seen on a year-over-year basis since October 1999. On top of this, the refi index is near the lowest levels since the year of 2000. In other words, the amount of people submitting applications for refis right now is more or less at a 22-year low right now. So that's refis. Let's have a look at purchase applications though. Because those decreased by 2% from last week and was down a whopping 41% compared to the same time period 1 year ago. But wait, there's more. Have a look at this. Purchase applications have now decreased in 15 out of the last 18 weeks. There's only been 3 weeks over the past 18 weeks where the number of purchase applications actually increased. Absolutely insane. And this, of course, is because of rising rates, of course, right? On top of this, the purchase index hasn't been this low since January of 2015. And you actually can see this right here when looking at the Mortgage News Daily's website. So here's their purchase index over time. So their purchase index right now is at an index at 160.5. Back in January 5th of 2015, their index was 159.2. The significance regarding this as well is that 160.5 is actually lower than April of 2020 when we had more or less stay-at-home orders across the nation. So that, in my opinion, really tells us a lot, given the fact we have fewer applications in order to buy houses right now compared to the beginning of April when we had stay-at-home orders across much of the nation. And going back to the MBA's report here, Joel Kahn, who's the Deputy Chief Economist of the MBA, stated the following here. Mortgage applications declined for the 6th consecutive week despite a slight drop in rates. The 30-year fixed rate mortgage decreased for the first time in over 2 months to 7.06%, but remained close to the highs we saw back in 2002. These elevated rates continue to put pressure on both purchase and refinance activity and have added to the ongoing affordability challenges impacting our housing market, of course. And speaking of affordability challenges, I have an update for you guys regarding the increase in the average monthly mortgage payment from 12 months ago. So the median sold price 1 year ago was $355,100. That's the median sold price nationwide, according to the National Association of Realtors. Also, 1 year ago, the average 30-year fix was 3.14%. So your P&I payment would be $1,219 per month 1 year ago. Fast forward to today, though, look at this. Median sold price, $384,800, again, according to the National Association of Realtors. And average rates right now at 7.12%. That would give you a new housing payment of $2,072 per month. And by my dumb math, that's an increase of $854 more per month to buy a median price home today versus 12 months ago, or a 70% increase in your monthly housing payment. And that right there is one of the main reasons why I believe our housing market's slowing down greatly, given the fact that the average monthly housing payment is up almost $900 more per month versus 1 year ago. And we're just talking about the median sold price, right? We're talking about houses of $500,000 to $700,000 and more. Your average monthly mortgage payment would be hundreds, actually probably thousands of dollars more compared to a year ago. Now, here's something else I want to bring to your attention as well that I have not mentioned on this channel yet, because I actually noticed this just the other day. So again, 1 year ago, your payment would be $1,219 per month. But look at the difference between principal and interest. You would be paying off about $476 per month in your principal, or paying off your loan balance by $476 per month for your first housing payment. And $743 would go to paying your interest. And so over the life of the loan, which is, this is a 30-year fix, your payoff date would be 2052. Your total interest paid over the life of this 30-year loan would be $155,000, just less than $155,000. Look at the difference though right now though. Your new housing payment, again, $2,072 per month. Look how much you're paying towards interest for your first housing payment, $1,827 per month versus your principal, only $246 per month. Versus $476 per month for 1 year ago. Look at this as well. Look at your total interest paid over the life of the loan, again for 30 years, for this new rate at 7.12%. I'll see a slightly higher loan balance here, but the main driver here is this giant increase in rates, up about 4 percentage points from 1 year ago. Look at this, $438,000 would be your total interest paid over the life of the loan, given rates right now. And compare this to 1 year ago, just under $155,000. So this is an increase of $283,000 more in interest payments due to this rise in rates and this slight increase in your loan balance. Now, this really just shows how home buyers are really facing a lot of headwinds right now. And it's really not too big of a surprise given the fact that we're seeing a decrease by 41% compared to 1 year ago in the number of people submitting applications to buy houses right now. The MBA also shared that of all the applications for mortgages, approximately 28.6% were for refis. Actually, I'm really surprised it's that high. So approximately 3 out of every 10 applications for mortgages are actually for refis. This is much lower compared to January 1st, because at the start this year, the share of applications for refis was actually 64%, and now it's 28.6%. Also, the share of adjustable rate mortgages, or ARMs, is at 11.8% right now. Now, the significance regarding this is that to start this year, the share of ARM applications was approximately 3.1%. Now it's 11.8%. In other words, the share of applications for ARMs has gone up about 4 times. And the reason why we're seeing 4 times the amount of applications for ARMs compared to January 1st of this year is because of this right here. The average 30-year fix with conforming loan balances, this means loan balances of less than $647,200. The average rate is 7.06% according to the MBA right here. But look at this. For a 5/1 ARM, meaning it's fixed for 5 years, then it becomes adjustable after that, is at 5.79%. So in other words, the spread between a 30-year fixed versus a 5/1 ARM is 1.27 percentage points. So the reason why we're seeing this increase in the number of applications for ARMs is because your interest rate at 5.79% is obviously a lot lower than 7.06%, making your housing payment much more affordable. However, though, even though your housing payment would be much more affordable for a 5/1 ARM, for example, versus a 30-year fixed, using a 5/1 ARM is very, very risky in my personal opinion, given the fact that your rate is only fixed for 5 years versus a 30-year fix, where of course that is fixed for 30 years. And given the environment we're in right now with rising rates, an adjustable rate mortgage is much more risky. And with that said, please comment below your biggest takeaways from today's video. Also, if you guys got any value in this video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day and look forward to seeing you on the next video.